All right. Hey everyone, it's Brian with Tiny Crypto Blog. It's been a long time, but only because there hasn't been that much going on in the space. Things have evolved and it's matured, and it actually kind of ties in with what I was going to show you guys. So, Arca Finance, they've been following the crypto space for a while, and I've been reading the newsletter for 5 or 6 years, maybe. And I happened to catch their recent newsletter 8 years later, where it's sort of a recap. And I want to read this. As I read it through, there were a lot of points that came up that I wanted to do some commentary on. So I'm going to read through it. This one's going to be a while, so grab yourself, pause it if you need to, grab yourself something to drink. Some ideas aged poorly. Others simply took longer than expected. I've been writing our two Satoshis almost every week for nearly 8 years and have published close to 400 articles, while simultaneously, here, I'm just going to skip around. So Jeff Dorman, he is their chief investor. He's been writing a lot of articles, and as he says, they've wrote on a whole bunch of things from a financial perspective, sort of an outsider perspective looking in. DeFi, stablecoins, NFTs, gaming, token economics, governance, regulations, bankruptcies, public equities, and the convergence of crypto and traditional finance. And as he says, he's been wrong many times. He started going through the archives and said, many of the themes I wrote about repeatedly, often when they're unpopular or premature, are beginning to play out. Crypto was always bigger than Bitcoin. One of my earliest frustrations was the way traditional investors view digital assets was that almost every conversation started and ended with Bitcoin. And that was the case. At the time, and if you were around during then, you'll remember this, almost everything is grouped into one useless and mislabeled category: cryptocurrency. Bitcoin, exchange tokens, utility tokens, tokenized securities, and early governance assets were treated as if they were interchangeable simply because they use similar technology. Correct. What do we had? We had two things. We had Bitcoin and altcoins, alternatives to Bitcoin. But yes, everything was lumped together. And it took the bear of 2021, or the bull and bear of 2021, and then the adoption of Bitcoin as a treasury asset, as a monetary asset, to further create that differentiation in the digital assets. They were not interchangeable then, and they certainly are not today. Today, Bitcoin has become a macro asset, a treasury asset, an ETF product, and a form of non-sovereign money. Stablecoins have become a global payment and settlement network. Smart contract platforms sell block space. DeFi protocols facilitate trading, lending, asset issuance. Other tokens resemble loyalty programs, commodities, governance instruments, or equity-like claims on the business. The industry did not develop into one giant homogeneous crypto market. It developed, as I just said, into several distinct sectors that happen to use blockchain infrastructure. The distinction seems obvious today, but it was far less obvious in 2029. Fundamentals eventually win. Perhaps the most consistent theme across 8 years of writing has been that digital assets would eventually need to be analyzed like instruments. And here we're getting into tokenomics. In the early years, this one makes me laugh so hard. In the early years, even sophisticated investors often argued that crypto assets could not be valued because they had no cash flows or intrinsic value. Meanwhile, crypto native investors frequently went too far in the opposite direction, pretending that users, total value locked, Discord activity, or a large community automatically created token value. And yes, that does create, having a community does create an underlying demand, because you have people that are supportive of the protocol or the asset. So it's there, but it's not necessarily something that, well, as we read, will come into a bigger picture. In that same article, I highlighted exchange tokens whose holders received trading benefits and whose issuers used profits for token buybacks. These were not currencies. They were mechanisms that allowed customers and investors to participate in the growth of an underlying business. This was the BNB coin. I remember that in the early days. I think it was 2018, late 17, early 18 when it was launched. And the whole idea was if you could trade at, I'm just pulling numbers out of my rear end. You can make a trade on Binance and it would be a 3% or 3.5% commission that you'd pay. Or if you held BNB coin tokens in your account, it would be cut to like 1.5 or 2 or something like that. So there was an incentive. It was a usage token with an incentive, and then it became a tradable asset. And then I think, because I have not followed this for the longest time, maybe it's used on fuel for their smart contract platform. Done now. If it is, feel free to chime up in the comments. By February 2021, the differentiation was becoming much clearer. While most observers still refer to everything outside Bitcoin as an altcoin, rewrote, the growth in DeFi from a fundamental usage standpoint has been nothing short of outstanding, and the price of underlying tokens, many of which directly benefit from this growth of users and revenues, has naturally followed. But many casual market observers and even some industry professionals like to collectively refer to these assets that aren't Bitcoin as altcoins, an archaic term that is at best confusing and at worst misses the entire evolution of the asset class. This characterization incorrectly assumes that all digital assets are homogeneous, which they're not, and that owning Bitcoin or non-Bitcoin tokens requires a mutually exclusive choice, like betting on Tiger Woods versus the field at Augusta. Remember, how many times was it a thing? When is it altcoin season, where Bitcoin would have its rise in price, go through its cycle, and then altcoins would follow? Altcoin season. And it was like that. But the asset class continues to differentiate and bifurcate, and even the loudest Bitcoin maximalists are being forced to pay attention. A few months later, this thesis became even more explicit. Real companies with real cash flows, a token that accrues economic value, and a way to measure its success. These companies also align their customers, employees, and other stakeholders with their success. And that is when they are talking about, I talk about the need for policy and laws that give definition and sort of rails to everything. The problem was, yes, a company or protocol could use a token to attract customers, bootstrap a network, reward contributors, distribute ownership, and return economic value to its stakeholders. But the problem was most projects did not use it properly. Instead, the industry spent years issuing governance tokens with no meaningful rights, excessive inflation, unnecessary venture unlocks, and little connection between the success of the product and the value of the token. Adoption increased, but token holders often receive none of the economic benefits. We are finally seeing the market reject that model. Investors now ask questions they should have been asking all along. Does the business generate revenue? Who receives that revenue? Does the token have a claim on cash flows? Are there buybacks? How much dilution exists? How is everyone aligned? And he says, Hyperliquid is the clearest current example. The protocol generates real revenue, and the overwhelming majority of that revenue is used to purchase hype in the open market. Investors can analyze volumes, revenues, margins, competition, and the resulting demand for the token. The fundamentals, they simply look at there. The investable token universe is much smaller than a token universe. Basically, there's diamonds in the rough, and there's a lot of rough. Crypto is extremely good at creating assets, has been far less successful at creating good investments. There are millions of new tokens, but most have no durable economic rights, no defensible competitive advantage, no rational governance structure, and no clear reason to exist. Many tokens were created primarily because founders and venture investors wanted liquidity, not because the underlying product needed a token. I'm remembering 2017, there was an Asian token out there. I'm trying to remember because it had its popularity. I'm gonna hold on a second here. The name's slowly coming to mind, but their whole thing was, it was like something with supply chain or something like that, and the token was supposed to be tied to things. And I'm reading into this and doing some of my own, DYOR, do your own research, and I'm finding the token has absolutely nothing to do with the operations of the company. The token wasn't being used by the company to track something or to be a claim on the value or the revenues or anything like that. It was just, here's a company, they issued a token. And what are you involved with? Well, we do supply chain and we track clothing in the Philippines. And yeah, it was a shit coin. And it turns out, coin disappeared.
Then I went, money gone.
Continuing. The issues become more pronounced as as launching a token has become easier. The barriers are basically non-existent. But the uncomfortable conclusion is that blockchain technology can succeed enormously while most existing tokens fail. Stablecoin volumes can grow without value accruing to the token itself of the blockchain being used. I've brought this up many a times, that the price of a coin or a token does not automatically correlate to the success of a protocol. A protocol can achieve widespread adoption while the underlying token tied to that protocol doesn't go anywhere. I just look at smart contract platforms over the last 2-3 years. Ethereum, Cardano, Chainlink. Chainlink, I could see, if I see some of the economics of it where you have to lock up tokens in order to run a node, which the reward for operating that node is more tokens, and those tokens can be sold on the open market. In which case, I understand that there's a value proposition being put in place there. But for people to use and connect to and use the protocol itself, well, you need to buy some. It's been a while since I've actually looked into Chainlink and how it works. If you're trying to draw data from something, who has to provide the tokens for the usage? But for a company to use it as a bridge, the protocol itself, the price of the token doesn't determine, oh, price is going up, we should be using this token, the price is going down. What's determining it, the usage, is the protocol itself. Okay, it looks like the sun has hid again. I'd like to open up that window. All right. In which case, saying right here, the success of a protocol or a token they're not dependent to one another. BlackRock can tokenize a fund using DeFi infrastructure without meaningfully benefiting the governance token associated with the DeFi infrastructure. A bank can launch its own blockchain, its own stablecoin, and its own tokenized products while keeping nearly all the economics inside the bank. If you want to think of an example of going back a few steps to garbage tokens, remember Dragon Coin? People made fun of it and called it Disney Coin, because I don't know if it was Disney that actually issued it, but they were trying their own blockchain, or they were backing it, or one of the two. But Dragon Chain, I remember it was a blue dragon, and people are gaga all over that one. When's the last time you heard about that? Adoption does not automatically create value accrual. Thank you. This is why the investable universe has remained so small. In April 2026, I wrote, there are at most 20 companies in quadrant 1 where the project or company is achieving some success and the token was designed properly to capture value from that success. The best way to move forward is to focus on the 10-20 tokens that are investable, ignore the rest, and require tokens to be built properly before giving them liquidity and visibility. Until exchanges, market makers, and other powerful gatekeepers agree on some level of token standards, expect more of the same apathetic, down-only price action. All right. Investors should stop treating every liquid token as an investable asset. Liquidity does not make something well designed. An exchange listing does not create fundamental value, and a successful application does not necessarily produce a successful token. If we look at, that's exactly what's been playing out over the last several years. The wheat's being sorted from the chaff, and as the crypto space has evolved, as it has grown and started to penetrate the mainstream society and everyday applications, its nature has changed. And back in the days when it was still early adoption and trying to gain legitimacy, you'd have the big deal was a Coinbase listing. Something get listed on Coinbase because they were very stingy about it. They list Litecoin. They list Ethereum. There would be a bump in the price. And back in the early days of adoption, price was one of those metrics we used to measure adoption, because the more the price went up, the more attention it got. The more attention it got, the more critical mass it would achieve. And also, too, for those of us who had bought in earlier, it also meant the value of our holdings increased, which was a very nice thing. But now we've reached a point, actually several years back, where the rubber hits the road, and these digital assets are now commercialized. Whether we like it or not, this is what mainstream adoption looks like, and it's commercialized. And when I think about, the rant about 4 weeks ago by Charles Hoskinson about community voting and evolving, basically transitioning Cardano from a hobby project to a regular everyday use protocol, exactly what's being discussed here. He went on a rant, and it did not follow the subsequent video to it, but he blew his stack, and it's like, you've got a bunch of people who are exercising their voting authority for how the community fund should be used. I'm saying, hey, let's move this into the commercial realm, and you guys are screw the man. Government's going to take it over. Big business and corporations are going to take it over. Screw them. We're going to be decentralized. And they're acting like, the early days of crypto, where it was originally created as an alternative to the banking system. Well, Jeff goes into this later. The next generation of winners will look less like speculative instruments and more like properly structured businesses, recurring revenue, transparent economics, rational dilution, strong governance, and a mechanism that allows owners to participate in the upside. So I read that as there are going to be companies who create a blockchain or some sort of blockchain related technology, and the tokens are going to be tied in. They're going to be an actual live application for business. And that's what's going to create that value. It's not going to be the hobby project that happens to become popular. That might happen, but you're going to be seeing more businesses. There may eventually be hundreds of those assets. And still, in fact, I still think most investable tokens in the future will be issued by existing non-blockchain companies like Netflix, Disney, Amazon, Dragon Gin, universities, small local businesses, and municipalities. But today, there's still a very few. Wall Street was never going to be replaced. For years, crypto was framed as an ideological war between decentralized networks and traditional finance. Crypto was supposedly going to eliminate banks, brokers, asset managers, exchanges, and payment companies. I remember that. Wall Street was the enemy, decentralization was the goal, and every intermediary was designed to disappear. I never found that framing particularly convincing. Capitalism is good at why? Because capitalism is good at absorbing useful technology. If blockchain improves settlement, distribution, collateral mobility, transparency, or production creation, financial institutions will adopt it, not because they suddenly believe in crypto's ideology, but because they want the revenue. Basically, Bitcoin, blockchain, they're Trojan horses. They're changing the system from within. Something outside of traditional finance has application inside traditional finance. So from that perspective, crypto's a Trojan horse. But just like just like I'm trying to remember my Marvel because I'm not a big Marvel fan. Just like Jarvis and that other program they created, Sentience, they merge. Just like in Ghost in the Shell, the two entities of Sentience, they merge. And we're going to see the same here. The protocols and blockchain is going to change, but businesses are going to change too. And that's the victory. The victory in that technology was made that is going to have its effect, but it's just going to be within the framework of the existing structure. And by its nature, it's going to change how those interactions are done. And that is the victory. That is the victory. That is how we change the world. There was nothing wrong with believing, saying we want to, what was mentioned here, we want to, screw the banks, screw the brokers, screw the asset managers, because there are things that can be manipulated and bending the rules for narrow gain. But these protocols are going to change how they do things. And in order to use these tools, they must yield to them. There's going to be closed networks. There's going to be permission networks. There's also going to be open source networks. That they will continue to exist, and that existing mainstream entities will use these things. That's the victory. That is the victory. That is the victory. Bitcoin will leave the world. Let's see. Profitable blockchain success. Early in the days, Wall Street could not profit from the success. They had advisory fees for businesses, but now that real growth is underway. BlackRock is issuing tokenized funds. Robinhood's building blockchain infrastructure and offering tokenized securities. Tokenizing everything, Woody, everything. Public companies are combining operating businesses, data centers, and traditional exchanges are exploring around-the-clock markets. Banks and fintech companies are developing stablecoins. Asset managers are launching products tied to an expanding range of digital assets. And Wall Street is not being replaced by crypto. Wall Street is becoming crypto, or more accurately, blockchain is becoming another layer of the financial system. Our victory. Most of the world's assets will move on chain. And this is one where we can look and try and look for all the signals and say, in April 2020, we highlighted A portfolio preparing to tokenize part of its holdings. The goal was straightforward: reduce paperwork, expand access, create secondary liquidity for an asset that historically had very little. The projects from that era were often too early. The infrastructure was incomplete, regulations were unclear, distribution was limited, and most investors had no idea how to access these products. All correct. But the underlying idea was correct. Skip ahead to 2025. As these barriers, yes, blockchain technology has proven to work incredibly well for asset movement and transfer, but the majority of the world's most popular assets are not available yet on blockchain rails due largely to regulatory and workflow issues. Remember we said earlier about a financial incentive? Think back to Donald Trump and what he's doing with, we're going to make this the crypto capital of the world. Maybe he said the Bitcoin capital. Doesn't matter. By having legislation that gives definition to digital assets, it creates the regulatory rails to give people things to do. And that is what makes the opportunity so large. The existing crypto market remains tiny relative to global stocks, bonds, real estate, and private assets. There's roughly 30 billion of real world assets on chain today, which I would take to mean issued on chain, where they're legitimate legal claims of some way, shape, or form. The total amount of stocks, bonds, and real estate assets is currently over 700 trillion US dollars. The next wave of blockchain adoption does not require investors to abandon those assets. It simply requires those assets to migrate onto better rails. So a lot of everyday transactions, and the beneficiaries will not necessarily be every existing token. Some institutions will build private networks and retain the economics themselves, but the broad trend is now undeniable. Tokenization is moving from PowerPoint presentations and small experiments toward actual products and distribution. And to reemphasize the point, the asset class is converging with the financial system, not operating alongside of it. It is changing things from within. It is the Trojan horse. And thanks for sticking around this long. We're almost done. Stablecoins were the killer application hiding in plain sight. Evil stablecoins. Crypto spent years searching for a killer application, while stablecoins quietly became one. The early narrative focused on replacing fiat currencies, but most consumers did not want a new unit of account. They wanted a better way to use the unit of account they already understood, and stablecoins solve that problem. They allow dollars to move globally, continuously, and programmably. They can settle transactions outside banking hours, serve as collateral in on-chain markets, and provide dollar access in countries with unstable currencies and connect traditional financial assets to blockchain infrastructure. If you take away the implications of it being a permissioned, essentially a permissioned cryptocurrency or crypto asset, blockchain asset, and you put aside how it can be used and how it can corral people and just look at it strictly from a protocol and a usage standpoint minus those connotations, it works. It works. And its adoption and usage is showing its popularity. It is a successful technology. Today, payment companies, banks, brokerages, fintech firms, exchanges, and asset managers all want a stablecoin strategy. The debate is no longer whether stablecoins have product market fit. The debate is about distribution and economics. Who owns the customer? Who holds the reserves? Who earns the interest? Which blockchain settles the transaction? How much revenue must the issuer pay to exchanges, wallets, protocols, or other distribution partners? Stablecoins may be crypto's greatest success, but they illustrate the value accrual problem perfectly. Enormous usage does not guarantee that the issuer, blockchain application, or token holder captures the economics. Circle and Coinbase can help expand USDC while paying away much of that revenue reserve income to distribution partners. A blockchain can process billions of dollars of stablecoin volume without generating enough revenue to justify its token's valuation. Point again. Excuse me. The technology is working. What used to be a race for market share is now becoming a race for profits. With 4% interest rates in short duration bonds, a $10 billion stablecoin is producing annual investment gains of $400 million, none of which passes through to the owners of the tokens. Collecting interest off the float is a big business for stablecoin issuers. Tether has assets of almost $70 billion. That's a spicy meatball. And the final one, regulation was never the enemy, uncertainty was. To wit, crypto's relationship with regulation has always been presented too simplistically. The industry often argued that regulation would kill innovation. Critics argued that regulation would expose crypto as having no legitimate use. Both sides largely missed the point. Institutional investors can operate under strict rules. What they struggled with is not knowing which rules apply. For years, projects face, and if you're back from the day, you know you've heard this story before. Projects face an impossible choice. Issue a token with meaningful economic rights and risk being sued by the SEC, right? Or issue a largely useless governance token and hope that vague promises of future utility would create value. Wasn't that one of the promises that almost every single protocol had, or that the backers and supporters and adherents of a protocol would say? Not to say that future utility won't create value, but to wit, that was the crime. The result was predictable. Thousands of poorly structured tokens were launched because teams were explicitly advised not to connect token value to the success of their businesses. The rules and the laws from way back when, that was a big deal. Immediate examples are not coming to mind as far as the protocols that drew, and the people behind them that drew the ire of the SEC for, say, operating without a proper business license, or, God, what was the big thing under Gensler that people get tagged with? Oh, does it pass the Howey test? Am I remembering that name right? The Dewey test, where, is this an investable asset? And all the protocols where a token would be subject to it. Ethereum, I think, fell into that. The legal risk. Back in 2023, he wrote, the legal risk is often used as a shield to avoid providing value to token holders. The ongoing lack of legal clarity in the US has left the majority of government's tokens in limbo, which they did. Regulatory uncertainty did not protect investors. It actively encouraged worse token design. Rug pulls. That is finally beginning to change. Stablecoin legislation, market structure proposals, clearer agency guidance, tokenization frameworks, which I agree need to be in place, and a more constructive regulatory posture are giving issuers a path towards creating assets with actual rights, which is, I think, something that we've all wanted from the get-go. We hold that token, we have a claim on ownership in one shape or another, whether it's revenue, accumulation of value, governance voting, the future of the protocol and funding projects, whatever it might be, having some sort of stake, some sort of ownership. The importance is not simply that regulation will allow prices to go higher, it's that clearer rules will allow better products to exist. And that's going to create a multiplier effect. As companies start having protocols that adhere to these rules, more companies will want to adopt it. And as more companies adopt it, more rules, laws, and regulations will be drafted giving definition to these things, which in turn will create more certainty, which in turn, all the prior usage and all the new legislation will incentivize companies and encourage companies to look into this, hop on board, and it just grows and grows and grows. In very simplistic terms, crypto never needed a complete absence of regulation. It needed rules that acknowledged that digital commodities, tokenized securities, stablecoins, governance instruments, and decentralized networks are not all the same thing. Thank you very much. Clear regulations should reduce bad speculation by making good investment structures possible. And finally, the future of crypto looks more like finance than crypto. 8 years ago, the digital asset industry was largely a collection of disconnected experiments. True. Today, the shape of the future is much clearer. Bitcoin is a macro-owned treasury asset. Stablecoins are becoming part of payment and settlement rails. Tokenized securities are bringing traditional assets on chain. Oh, does that mean Ravencoin's finally going to have some value? DeFi protocols are becoming exchanges, lenders, and clearing infrastructure. Certain tokens are developing equity-like economic characteristics through revenues and buybacks. Traditional finance institutions are becoming major blockchain developers, issuers, and distributors. And the line separating crypto from finance is becoming increasingly meaningless. The larger structural themes survived. Blockchain technology works extremely well for creating, transferring, trading, and settling assets. Investors will pay for assets that provide real economic rights. Institutions will adopt technology that creates new revenue or lowers costs. Trojan horse. And markets will eventually distinguish between a useful product and an investable asset. Yes. The industry has not reached its final form. In many ways, it's now only becoming what we thought it could be 8 years ago. So, yeah, it is, but it takes time. We saw the potential, and we saw the potential of it, and once it hit the water or hit the ground, it took time to just disperse and filter and trickle down and transform and become what it is today. So we have a baseline of adoption, of mainstream adoption, and we can watch from here and see how do these things pick up? How is its usage, its application, the discussion about it, how does that pick up or slow down? And we can gauge where we're at in the space. And then as far as owning digital assets, make plans for whatever actions we want to take accordingly. If we want to own tokens, just to own tokens in the network, not for an economic value, like say, I'm going to accumulate a lot of airline miles and then redeem them in or something. Someone can do that. If someone says, I want to buy and speculate on the value of an asset, you can do that. That's the beauty of it. So what are we underestimating today? Final part. Thanks for making it this long. Looking backwards, false inevitability. It's easy to now say stablecoins were an obvious product and that Wall Street was always going to adopt blockchain, or that investors would eventually demand cash flows and better token structures. None of those outcomes felt inevitable at the time. True. The ideas were visible, but the timelines were uncertain. And between the original thesis and the eventual outcome were multiple bubbles, crashes, frauds, bankruptcies, regulatory attacks, failed products, and long periods where almost nobody cared. And he says, finally wrapping up, that's been the glory of writing our two Satoshis. And yeah, okay, Jeff Dorman's the Chief Investment Officer at Arca. Here, their web address is www.ar.ca. They've got good insights. It's a little more institutional, but also, too, they take a outside perspective and look at things in a macro context and kind of look in the micro in some details. And yeah, it's just a good source of perspective from someone who spends the time in the space so that you don't have to. I signed up for their online for their email newsletter, and that's how I got notified of this. And they also have a YouTube page where they'll publish all their stuff, Arca Finance. So you can find that on YouTube. So yeah, there you go. And anyway, here we are. So yes, I wanted to read that through because I feel like a lot of the themes that I commented on are things that I lived through and observed myself, as far as the changing of the themes, the further segmentation and definition for protocols coming into play, where it's not just an amalgamous blob of crypto, but just like a stock market, companies do different things, and those stocks are tied to companies that do different things, and these protocols, these blockchain protocols, do different things. So I will wrap it up there. Whoa, this was long, 41 minutes. Whoa. So thanks for sticking around. Got any comments? Throw them below. Thanks for watching. You can follow. Oh, yeah. None of this was financial advice, mind you. You should always do your own research and know the risks. TYOR. And yeah, that was Brian of Tiny Crypto Blog. So with that, you can follow along in all the social media sites listed in the show notes. And with that, be well, everyone, and talk to you soon.